Today is the 25th of February, 2025. A special guest, Thomas Byron. Thomas has an amazing workshop. I think it's the most complete option trading workshop I've ever seen, and runs two alert systems, the ATM alerts and also the newer Elephant Shield. So it's been going on for, I guess, about a year now, right? So this is the annual update to show how it's been going. The Elephant Shield, obviously not so long, it's newer. But welcome, Thomas. It's good to hear how your alerts and everything are going. I know I've had a lot of positive feedback from your customers.
Thank you very much, Tom, and welcome everybody. Yeah, it's been a year or so, and the other alert, the Elephant Shield, has been, I think, a little bit more than 2 months, I would say, and it's been a nice experience. And today we are basically introducing the three services. I will call it the service, and they are the two alerts, but they are both based on the same principle, basically on the same concept, and that is the workshop. The workshop is dealing with time spread mainly, but not only, because I think that if you follow the time spread, you probably have a more or less an understanding of option trading in general. So let me move to the next. Okay, the disclaimer. Alpha and Omega and Thomas Byron are not a broker-dealer or investment advisor. The content given by Alpha and Omega is strictly for educational purposes only. Options, futures, bonds, and currencies involve risk and are not suitable for all investors. Past performance is not necessarily indicative of future results. Okay, so a little bit about me. I've been in the trading arena for too long, I would say, more or less 35 years. I started as an oil trader, energy trader, on the physical side. Then after many years there, basically dealing with physical oil cargoes, middle distillates, and stuff like that. I switched to more derivatives kind of business, working for investment banks, you know, on the hedging side, and always as a trader. And later, you know, after more or less 20 years doing that, I started a career, put it this way, dealing with derivatives alone, leaving alone the physical oil business. And I started, you know, trading my own money, doing advisory and other stuff. And as I point out, this is about a year experience as a mentor. I never really thought about mentoring, but when I was teaching people, there were mostly other professional traders on my desk, and whether in the energy or derivatives. That's a little bit recap about me. These are the three. I'll go fast because this is a PDF, and you will have all the information on this, and you read it at your own pace and with time. You have the workshop, and based on the workshop, there are two services as trade alerts. I decided to prove it, and so I also have a trade alert, and as Tom was saying, lately, a little bit longer DTE kind of alert that is called the Elephant Shield. Okay, the core concept of this, and I will define this lower later in the presentation. We trade based on statistics and probability. We try to define risk and stay the minimum amount of time as possible. we seek positive theta. The trades are simple. We put them as a block. Profit target. This is in general, right? Then we will define the differences between the two alerts. But this is the philosophy of this kind of trades, right? The profit target is between 5 and 20% of the debit paid, and stocks, advantages trading. Mostly we trade SPX, but not only. So the time spread that we cover, I would say they go from 0 from 15 DTE for the short side, for the leg, put it this way. I'm not talking about just a simple calendar, but in general, right? What you're short is 0 to 15, 2 weeks, and you're long 2 days to 30 days. This is more or less the time frame that we are covering. And we use calendars, double calendars, diagonal, double diagonal, strangle, but we tend to hedge the position, the early position by staying as close as possible to at the money and to keep a delta neutral kind of position. So the thing is that I lost my crystal ball a few years back, so I am, I have a team, by the way, so that's when I say we, it's not just me, right? But predicting the future, it's not part of this kind of trades, right? We need to react and to stay where our money is rewarded with risk. That's basically what it is, right? So to do that, we have sort of list of things that we need to do. We have to determine the market status. That doesn't mean whether the market will go up or down. A market status for options, right? For what we trade. We don't trade the underlying, we trade the derivatives of the underlying, whatever that would be. In this case, it's SPX, but could be Apple, could be a single stock, an index, a Forex, whatever that is. So, and we're trying to see the performance of the strategy after we analyze the market status that best fits the market that we see. Then we select the strategies that we think will fit our analysis. We execute the order, and this is very important. We monitor and adjust the trades. These are not static trades that you lead them and they'll work by themselves. So you need a bit of participation. Then we exit the trades. Okay, I'm talking about the workshop now. What is in the workshop? Workshop has been recorded a year ago. That's why it's the annual anniversary. And it's made of 4 classes. The time of the 4 classes is about 2 hours and 30 minutes the first, 3 hours and 5 hours, and it's a long. And they were all recorded live with examples, and it's all recorded, and you can watch it at any time. So as I said, there are 4 classes following the subject. Then I provided many complementary that I think are fundamental for understanding this subject. And this is made of spreadsheet, links to places where you can find information, my own videos and stuff like that. In total, I put here a list. There are about 40. So these are videos that I recorded. There are some external videos where they were the presentation was probably better than mine. That doesn't take much. So, but there are 40 of this kind of thing, and these are integral parts of the understanding of the subject, right? And we'll go not in details, but I will show you how you find this inside the workshop. So you can see there are videos here, different subject, and then there are sort of guide on derivatives. Let me make clear. This is not a single strategy. This is not. This will give you from 0 to proficient. All you need to know for trading this kind of strategy in and using time spread, and not only. So to do that, since the audience to me was unknown, I need to cover the basics, right? Because I want to be sure that you get the direction right of what we're doing, right? So I know the subject could be vast, but this is like a buffet. You don't have to eat all at the same time, right? So continue on this. There are some software that I designed myself. There are some other links to other spreadsheets, but I'll continue on the list. These are all the things that you will find inside the workshop. And I'll keep going. You will see this. You can read this PDF will be provided to you, so you can have a look later. Okay, so this is once you are inside the workshop, the list is provided in this form. This is called the library, where all the recorded videos, the PDF, or the presentation, or the other things are. And mostly videos here and presentation of the videos. Then you have here the documents, where you can download anytime the documents that I listed before. And this is important, pay attention, because if you decide to do a workshop, that I hope you will, because it's a fundamental to the alerts, some of the, or you, one alert or the other, you will have this PDF where you can decide what material is covered. Some material, it's in both, right? It's generic, because let's say you subscribe to the alert, but not the workshop, but I still feel that you should have some of the material covered here. So continue down. Now, let's talk about the alerts. The initial alerts were faster, and they were covering a shorter tenor, all right? And this is called ATM Trade Alerts. Same thing, it's based on the core, as we said, and you will notice that this, in the next slide, will have this kind of the short will be 0, 1, 2, up to 7, I would say, and the long will be from 2 to 7. So it's roughly within, let's say, 10 days, 2 weeks maximum, right? Same thing as before, because it's based exactly on the workshop. This is another video that you will find. It's how you manage lots and how you basically you grow your lots according to what you can do. You can watch this later. It's on YouTube. You just click the link like I did, and the video will start.
This is a dream spreadsheet, right? Obviously,
and
it will
this
not be so easy
spreadsheet
to reach results like this.
Is provided with the workshop. So these are the results from for this alert. I started with $25,000, and that was the 22nd of February last year, right? This is the growth of the account. These are the metrics. This will be available for you to check, verify in the members area. And these are, and I mix here the style. This you will find the P&L and the result of every single trade, right? This is the last one. Actually, we closed one today, but this is updated to yesterday, put it this way. Until we will see, we had a total of 112 trades in a year. Now there are two formats, the one I showed before and this one. I just put both and to see in the member area for you to follow which one you prefer, all right? And this is the progression of the account. Every single trade there listed there. This is an important part that I want to spend a little time. I keep this is my philosophy of trading, from energy to advisory. I keep money on reserve because there is already leverage in trading options, right? And I use that to hedge my positions. So this is the median, the average exposure in the market with this position. This position is not just one single position. It's a composite of various hedges and stuff, but no more than let's say, average 3 to 4 trades. Every single line you see as a complete trade, right? So the average is 2.7 days exposure. But bear in mind that some were longer trades, like 22 days and stuff like that. But roughly, it's the median, it's 1, right? The median, compared to the average, you cut the wings, put it this way. The maximum risk for the average of this is about short of $4,000. Okay. And so this is your total P&L, and this is the average profit on the money that you put at risk, right? So that said, how do you read this? That means that you had made this profit, the one I showed you before. You made $17,000 on top of the 25 of your initial capital, but you were risking basically at any given time no more than 15%, 20% of your capital. So even less. So this is the average, running of the 25K that you started, that, and so you made 17 on 25, but without being exposed to the market. So and that's very important, because, you may say that you use leverage, but you don't go crazy on leverage. And especially for that, the Sortino, the other numbers look very good. And the return on capital, if you take that kind of measurement, is 470%. That's what it is. Okay, so it's very important in trading that, I could say, all right, I start a position and I bet 25K. No, I start with 25, I bet 25K in my position. Well, that is a different profile. That's not how traders, professional traders think, because, that's the capital you start with. That's the only thing that brings you back in the market. You lose the 25K, you have to sell something, your car, your house. So you don't want to do that, even if you have a very profitable position, because you do this growing. And as I mentioned before, there was that video. How do I grow this with my P&L? I start with one lot. When I reach the unit, I move to 2 and 3 and 4 and so forth. And that's more. If you have time, please watch the video and the one that I mentioned before with the spreadsheet, how you grow your capital. Okay. So the second service, I call it this way, introduced in mid-December. I receive a lot of requests of something that follow the same principle, but it's not so active, or it's less active. And so I decided to do this other alert that is called the Elephant Shield. It's a longer tenor based on the same principle, but obviously it's less demanding. If you don't want to stay glued to your computer, we don't stay glued to the computer, but I say, I will stay glued to the computer for you, right? You just to follow the alerts. So it's a slower pace. And again, the principle, I just put it here, the same principle, to show you that, this is based exactly on the same principle, right? That's what is included. There are some other stuff that are necessary to include. And in this case, you will see that the same thing. The method is the same. But here we talk about 725 days. The alerts are 4 to 8. Right? The other one was much more many, because in a year I had 112, right, trades. So but that is result. That could be 3-4 times, right? The numbers of trades with adjustments, right? So a lot of alerts. Okay. So this is simple to trade. The profit is 3 to 30%, and we use SPX weekly. We could use the IX and other tools. So this will depend, but mostly like 95% of the time we use SPX, right? This, since it started, and this is started with $7,500, right? So it's a smaller account, but it's scalable, right? And that is up to basically yesterday. And these are the metrics, right? Same thing as I did in the other presentation. These are the trades. They are less intensive. You see the dates, day in the trades here, right? There are fewer adjustments, but the same principle of not risking your house in a single trade applies. And okay, that's what I just said. And this will take care of also the part of the trader rule. If you have a very small account under 25K, these trades will probably fit, and you don't have to do much to be worried about that. So this covers 7, 10, 15 as a short, 10 and 35 as the long leg, and trade more or less in the same way that the other, but with the catch here that on this one, it's, don't expect this, the trade you may stay, I don't know, 1 week without anything, nothing to do, right? Nothing happened. But at the same time, when you have to move, when you have to do something like protecting your position, when gamma starts getting more of a factor, you will have to dynamically adjust this one as well. With trading derivatives, there is not a deal that you can do and leave unattended, come back and be pleasantly surprised of what happened. So we don't share many information about the two alerts because we think that most of the information we share in a workshop. So it's just the media, the form or communication is this subject is quite vast. So there is no time, there is no space to explain the details. And I am like this: if I can't explain all the details, little information it's not. Sometimes could be dangerous. Superficiality, whatever you do, depends. There are people that can handle that, but some people may think, oh, I know everything. That's, bet the house. And I feel responsible. I don't like to do that. So same concept. I don't want to repeat myself. It's basically based on the same principle, right? And this is another concept that I want to pass. When the people say, oh, put this position on because it's a position that you don't have to stay glued to your computer, Well, I will, if you subscribe to an alert, I will be glued to the computer. You don't have to. That's why you have an alert, because somebody is watching, right? The word alert means that somebody will alert you, if something happened, right? We know we'll be on guard, If no alert, nobody is alerted if something happened, that's not how trading is done, right? These are basically the two alert service, right? The names. So why we trade SPX options? For various reasons, mostly because they are European style. They are very granular. They price every $5. I know you know that. They are cash settled, so you don't have to be afraid of assignment or anything like that. And they trade, since May 3 years ago, they trade every day. basically. So you can really spread your risk nicely. There are other reasons like, tax break. If you are in the States, they are treated differently. And I'm not promoting SPX. That SPX has a lot of media attention. You can find information about this. So let's move on. So when we said, and this is valid for the workshop, when we say market status, do I mean that I want to analyze the Fibonacci to say whether it's time to buy or sell? I don't even know what Fibonacci means, to be honest. So, well, I know, right? And this is not that I know. Everybody in derivatives knows this. It knows that the realized volatility, so what happened to any underlying, right, is normally less in terms of variation with the implied volatility, so the one before. So basically, there is a premium. There is a premium, and this is called the volatility risk premium, VRP. Everybody knows this, and this is very important because this is the main engine, not direction. This is the main engine of our system, where you make the money that is proven, all right? It's always been there since, the market has existed as an option market. So historically, you will see all the data later, it's 4 to 5 volatility points premium. Now, it will be nice to catch that all, but part of that premium, if you manage to catch it, will be enough. And you have to think this as an analogy. It's like the insurance premium, right? So to hedge risk from other people that trade for their own reason, they're long this, they're short that, whatever. As an insurance, you need to have something that cover you for the cost, and the risk. And so like exactly in insurance business, there is a volatility risk premium, right? It's not called a discount, it's called a premium. Obviously, that fluctuate, right? That is not fixed. You will read this now. I'm not going to read you this, and it will be tedious. But these fluctuations, anyway, as you can see, apart from a few exceptions here, they are positive. And if you say, it's about 4%, 4 points, percentage point. So this is the difference between VIX and 1 month's daily realized or whatever. But you can calculate this in various shape and form, and I will show you how you do. By the way, there is a video that explains this in details in, I think, in both either of the alerts, both, and the workshop in detail, right? But these are the numbers. These are the numbers of these volatility risk premiums where you find them. Let's say you don't want to trade the SPX, right? That's what we trade. That's why we trade SPX. It's 4.5 average, right? The Euro Stock 50, that is the equivalent in Europe, the 50 the biggest stocks in Europe, they have 4. Nikkei 225, 4. Other indexes, as you can say, 4. The Treasury 1.3. Gold 3.5, WTI crude 6.3, the euro dollar 1.4. So we are pretty happy, and this is measured since 1990. That's a lot of data about this. So we are pretty happy. You have to think that it's not really important what you trade. You can choose any underlying, but it's very important that you do it in a systematic way and you understand what you're doing, because it doesn't matter if you apply this to the euro, to the Nikkei, to the gold, the same principle applies, right? Obviously, that doesn't mean that you have to forecast the price of gold or the SPX. This is the premium you're trying to catch, and inside the formula, that premium and how you catch it, it's what we do, regardless of the direction. So there is a skew, though, because as you know, from 1987, when the big crash in Wall Street, the formula itself, it doesn't really work. And this is explained in the workshop many, many times in many shape and form. And this is explained with a video, specific video where I break down the Black-Scholes formula in any other service that you may decide to jump into. So, but basically there is a skew. So because there is more demand for various reasons for puts versus calls. So when you analyze what you do, you have to take care of that. And then modeling this, you can see that if the market move this way, right, you have many swings, but mathematically, let's say the volatility could be the same, right? Then one big jump, right? So you have to understand all those little things. And this is what we were saying. The skew in general for the equity market is this, right? It's elevated for puts and calls, or just say, you know, as this shape, right? Gold is the opposite, and Forex, it's a smile, right? Smurf, smile, these are all terms that they use to basically define the shape of the curve. Volatility skew, what we do, this just, I will tell you, this is all very well explained in the workshop. It's touched into the alerts, right? But that's what we do. That's what we are trying to, when we say the market status, that's what we're trying to establish. And these are, you know, the expectation, the forward price, variance, skewness, kurtosis. And this is what I just said, you know, supply and demand, the skew, why there is a skew, it's all listed there. Okay, now let's say that we analyze the market and now we trade on, that's the general market, but it's not our position. Then we define what position we want to take in the theme of time spread, right? And that becomes interesting. So we take a single trade, a specific trade. Here, for example, I chosen a double calendar, 10 wide, center at 50 delta. So let's say that the open 50 delta is at 4,500 for the SPX. You take a call 10 higher than that, and the puts 10 lower than that. So it's center 50 delta, 10 wide. The call and 10 wide on the other side. So it's 20 wide in total, but it's center at 50. So, but then we define with the statistical terms, the same kind of day. So that day there were the Federal Reserve meeting minutes released. So we want to know exactly, compare in a bucket statistically the same kind of trade, you know, with the same potential news or pending economic data and stuff like that. We visualize that in various form and shape. And by the way, with a workshop, I'll give you the tools to do this on your own, because I built this over the years and I use expensive tools, professional tools, because I started this many years ago when, you know, retail tools were not available and they were not cheap. You know, data was expensive and they were not. But now you can replicate the same kind of thing with, and I built a spreadsheet to do that. You can use it to basically follow this principle, right? Then you can start recording data using TOS, or you can buy, you know, data to fill that gap without recording from starting zero. And today data is very cheap, right? Option data I'm talking about. And this is the visual representation of, you know, whether you trade within, without, and stuff like that. There's an explanation. I'm not going to go, this is not going to be very long, but you can read this if you're interested. We'll explain briefly what is the method we choose. And this is what that will give you the collection of data. That will give you, every one of this is a date, right? And let's say they start when the market open, 9:31. It's 1 minute granularity here. Then if you can see here, there will be the average of this, right? And then there will be the different outcome. But bear in mind, this is float. Float in derivatives means this is not fixed. It's not fixed in price. This is that trade that we said, a 10 wide double calendar, always floating around 50 delta, right? So it's like if I have that trade always floating at 50 delta in every single day, similar day, let's say the Federal Reserve meeting day, for example, it will be a color line like this. As you can see, the average results, it looks good, right? Because it's above the zero. Then there are some outliner that's even better and some that lost money. But this is a good trade if you can keep it floating. Unfortunately, you can't keep it floating because the market will move, right? And also you will notice another thing, that the market has an acceleration at the open, it tends to be stable in the center, and accelerate at close. This is the effect of on a daily basis. This is a trade assuming that these trades will not expire the same day. This is not a zero DT. That means that performance in a day. So if I carry the next day over, this performance will continue from where it's left, right? Maybe this one even recover. We don't know that. But this will give us the indication whether that trade on the entry level is cheap, is expensive, at what stage it is, whether it's above or below average the premium. So on the first day, and then I will follow the second day, I will know whether that trade, similar trade, at that time, it's expensive or is it cheap? Because at the end of the day, we buy something trying to sell it higher. A block that is called a diagonal, a calendar, it's a new product. It's a combination, you know, of various parts, puts and calls, but it's something that you buy at one and try to sell higher. So, and there are many other examples. Now, this is the problem. This is a fix. So this is fixed at the open. So I take the position now. So as you can see, you know, some did well, some didn't, but this is your real position. And as I just said before, that is taken at the open. But let's assume, okay, maybe if I had to take 3 lots, for example, I take one at the open, that is good, nothing in the middle. As you can see, there is a tendency that nothing happened here. And maybe one more trade here, if I wanted to have a total of 3, because there is a tendency to go higher toward the close, right? And not in this case. In this case, actually, they went lower, right? Something happened here. But let's say normally the tendency is that they go up. So I scale in, scale out, and this is the statistical help to decide when to enter a trade. But this is not a daily trade. This is a specific trade on Wednesday, a specific trade in terms of width, you know, 50 delta, 10 wide, you know, at a certain specific time, specific days. Statistics is valid only if it's not generic, because you have to define, you know, you can say every single day, you know, in the last 100 years on the planet Earth, there was some rain. How does it help you if you are in Chicago or in Boston today, right? So you had to be specific. You had to know what is the average rain in Boston? What is the average rain in Chicago in July, in August, in September? And that is still not precise, but it's an analogy. It's like saying, oh, one day it will rain, right? Good. So this is the float of another example, right? And this is the fix. That's a little bit better, you see? And the data was PCI. These are the dates and these are your result. This is how they looks numerically, right? Every single minute here, they'll tell you what the money is, and we'll fix that trade you know, every minute, record it and put it in a graphical form, right? Now, we use to select the trades some mathematical model, neural models to identify some acceleration of the one I was saying, you know, whether is an acceleration on the premium and stuff like that. And we divided the day in 30 minutes here, you can see, basically 30 or more minutes to define in which part of the day you are and whether you see acceleration together with volume and stuff like that. I will not be able to share this, A, because it's very complicated, B, because it's a very sophisticated assets of tool using MATLAB, other stuff that is proprietary, but I give you something very similar. So remember, as a professional, you need to, we use smaller targets for bigger amount of money. For retail, it's the opposite. You have, put it this way, you had to put more money at risk, you know, but in absolute terms less. And probably you're not going to reach 10%. You'll be happy with 5, right? So it's the same thing. I will see you some on the, you can read this later. It's so now that we have defined, you know, what the strategy selection, okay, time spread, we decide this is the theme, right? But we also use broken wing butterfly. The problem is that we hedge them with the statistical advantage. We trade them differently, right? This is because we decided, you know, to you will read this implied volatility, 15 days, more or less. You get that. We also use broken wing butterfly, but for elephant shield especially, but we hedge them in a totally different way. These are some of the results, obviously not on $7,000, right? You make 15 on bigger, but the same principle apply to position, my position, so customer position. These are calendars that you can see. These are combinations, combos, double calendars. This is a what I call a butterfly with embedded a calendar and stuff like that. So this is, we do not trade using optimization, but this is roughly, we use optimization to see whether there is any optimization. We use option omega to follow the same trades and to see whether, without hedge, whether there is any validity in continuing to put those trades. Basically, this is what, you know, some of the trades in the elephant shield, same starting capital, combination of trades in a portfolio that's more or less match the performance that I show you up to now. So again, some of the other examples. Okay, this is you're probably aware if you're here, transaction cost and market condition, risk reward analysis. This is a comparison of, you know, the single, you know, they use funny names, but what is the leverage, what the odds of different positions. We discuss about the PDT rule. I hope you can avoid this. Okay, now the alerts. What do you find inside? Like I did for the workshop, this is what you will find inside the weekly, the one that started with 25 grand, right? You can see what material you find inside. So they are again. This is a video that I recorded talking about harvesting volatility. You know, there are other videos. These are the material that you can download, right? The guide, the spreadsheet. And this is some readings related, obviously, to the strategy. And so forth, so on. This is still the online documents, some other videos. This is the same for the new one, the elephant shield. Some are repeated because, you know, I think you need them anyway. So this is just a list of the documents. For you, it's good when you decide which one to, if you decide to do this, you can compare with the PDF. You can say, oh, if I take the workshop, but initially I want to take the elephant shield, this is the documents how I find inside, this is the style and so forth. Okay, this is a spreadsheet that I designed that will do calculation of your position in a different way. Most important one is they will decode the weighted bag gap by square rooting time, because we deal with calendars, so it's very important to have a proper reading of Vega. And any software out there won't be able to, it will not give you a proper Vega reading. This is some other, it's to basically to do, analyze butterflies and provide it to you. Option radar. Butterfly, ion condors, and stuff like that. It's a paid service that I designed. This is to put order inside. It's using basket order trader. That's what we name it. You can modify, morph position to be ready to go into basket order of interactive brokers only. There are videos how to use it. It's part of the various services. Now the deal. Let me go first if there is any question. Any question, Tom? I didn't. Let me
I
go
don't
to
see any.
Okay. No, I saw something flashing when I was talking on the chat. Probably it's.
Oh wait, there is something.
Yeah, I saw something there, but probably I can't see. There are 8 in the chat.
Yeah, it is recorded. How do you get the PDF of this talk? I'll put it with the recording in the library. Also, this will go on YouTube, so I'll put a link to the PDF there too. With elephant shield trays, do we only need to check them once per day? For example, end of day?
Well, end of day, I will not say end of day because I wish I could say that, but that depends on the market if you want to make money. I mean, if I tell you just, go there just once a day. What if the market moved 300 points? You go there once a day and you know that you lost the position lost in a way that is not recoverable. So no. But that's why I have people that follow this and you see the alert, you see the price, you have mobile devices, even if you are at the office, unless you're driving your car, you can stop. But it's not frantic, all right? You can put that order in and let it work. But to say just watch this thing once a day, it would be a lie. Because if you do that, you are market mercy, basically. So.
And then Adam asked for the workshop, does the software expire after 12 months?
No, the expires some of but I will renew it. The paid one is paid every year. This one and the basket order traded. But
Yeah, that's separate.
That's separate. But the rest will not expire. If I put an expiry, I will renew it if you are still a member, right?
Fair enough.
And the workshop, it will not expire. The one in the workshop will not expire. But let's say you are an alerter, right? That will expire after a year because you subscribe 1 quarter and then you keep like 25 spreadsheet. It's a bad deal for me, all right? So hopefully you'll come back because we all make money together, but it will expire in a year.
Okay, and then from the PDF, he thinks he saw Slack and email for the alerts. I think it's just Slack.
It is Slack, yeah.
And then
by the way, I forgot to mention that this includes, the workshop includes Discord channel with a year.
And he also asked, could you use ES instead of SPX?
Well, it's very expensive in terms of commissions. You can use it, but I don't recommend it because, there is no, okay, if you saying that because you want to have put it this way, put this position will cost you a lot on commissions. You cannot break 25 cents orders with ES, right? The only real advantage, if you have TOS, for instance, chart swap, and you are not interactive broker, you don't have extended trading hours, so you are at risk. So you can use something to adjust the trades that you took during the not regular market hours, but to do everything in ES, it doesn't make sense because it's more, you spend much more in commissions. There is no flexibility in terms of price. The orders, especially for time spread, cannot be done at the same time because they will not, in TOS, for instance, they will not cover that as a, you have to go first long and then short, right? Unless it's a week and a month, right, on the cycle of ES. So it's very annoying. It's not practical. I always recommend the best, not for analysis tools provided, but the best broker out there is Interactive Broker, right? Because you have extended traded hours, you can take a position and put an alert overnight and get filled overnight. By the time you wake up, you're already done. Your day is over before the open, all right? During the night while you sleep or have alerts and stuff like that. So
Another question, do you need the software like OptionNet Explorer to follow?
No, I don't recommend OptionNet. I use OptionNet Explorer, but I found that the broker, the one I mentioned, TOS, I don't know about Tasty Trade because I'm not American, so I cannot open an account there. But any broker will give you a software that is as good as the other one, because let's put it this way, the other software are good for people like me, that I'm a presenter, let's say, because I can show you some nice graphs, stuff like that. But all the analysis of that is wrong, right? Graphically is wrong. So it doesn't have any capability to see what happened in the future, right? Actually, could be misleading. And record in the past, and unless you have to present it, you have already your P&L in your broker account, and you have the software and interactive brokers, TOS. So I don't think you should spend money for that kind of stuff, unless you want to do research and see. Also, this one, people like to say, "Oh, take all my position and see how they fetch in how they did in the past." My position or your position, and that's you put historically inside one, and you think. And do you think that that is going to give you an advantage? I don't think so. I just said that when we did what I just said, statistical advantage is not curve fitting positions thinking that it will work because they did in the past. That's very, very wrong and very dangerous. So on top of that, you can do that in TOS a little bit, just as a curiosity to practice. But to pay a service to do that, to give you false hope that you find the grail and lose your money on top of the subscription, I don't think it's a good idea.
And next question is, how do subscribers get notified a trade is to be taken, adjusted, or exited? That's on Slack.
That's on Slack. That's live. Let me share this, because let's say today, for instance, how you get notified. I show you how you get notified.
Well, and one reason we use Slack is it's cross-platform. It works on a computer, laptop, iPad,
Everywhere.
phone, everything. And
Now,
okay, there's another question. Do trades or portfolio of trades have tail risk on the downside?
tail risk, what does it mean? Every position has a risk. The maximum risk of the calendar is the total price of a calendar you pay.
Right.
So if I
think
buy
it's just,
something,
I think they're just thinking like, a typical, like a condor or a wide Bergamo butterfly.
Okay, let me tell you this. Let's say a simple one. I buy a calendar, but it's not just calendar, but these are, when I say they are defined risk, it means that I'm not naked. I don't take widespread. I trade at the money and I stay at the money for a reason, because I want to have the odds in my favor. And you will see with the course what does it mean. It's like if I take a very cheap iron condor where my I'm 50 wide, I can make 10 bucks, but lose 90, all right? Okay, that's 90% of the time I'm right, but the time I lose 90. So it will take me 9 times to recover. But as you can see, that is not the kind of style of trade we're doing. But these positions are closed, meaning that the broker won't allow you to go, let's say you have a short and a long. If I try to close the long, naked short, every naked short option SPX will cost you a margin $93,000. So if you have, let's say, $150,000 and you close the long, will be fine. The broker won't close it, right? But if the market moves there, you are at risk, and there is no need to do that. But if you keep that, you have a smaller account, and let's say you trade a block, you trade a normal calendar that costs, let's say, $1, right? Well, the max, if you close the position when the short expire, right? The maximum you can lose on the trade is $1. I think that's should answer your question. I trade on EV. The format of the alerts is TOS, but easily. Yeah, well, I give you a visual as well. I tend to give you a visual, a print of my order. You know, orders are fairly simple.
And then for the elephant shield, how many adjustments per day do you normally have?
Well, that depends, because when the market moves $100, normally it's not like that. Actually, the elephant shield, you may have a position that expires in 30 days, right? You scale in slowly. So there is a position every 5 days, you know, a trade every 5 days up to reach a certain level. And then you may decide, if you already have money, because we want to stay at the money, if you stay at the money, you take them off and you roll to the next expiry. But if the market moves, you had to work that position around. And so in the last week or two, you had to be more active on that position. If the market moves, if the market doesn't move, that's fine. You roll it, right? The concept is this. I will have to decide, I mean, when to put a hedge, if it's too early, too late, you know, how to add more money to a certain exposure on that single position, and then layering that book with another position, earlier, later, different position. Basically, once the second position, independent trade, not the hedge of the first trade, could be the hedge of the first position. That's called layering. So I manage the whole book as a portfolio. And that's the difference between what you will find out there. You know, that I teach you how to trade, I don't know, a vertical. That's it. Okay. But that's vacuum. It's a vertical, right? After a while, you understand what the vertical is. But very few, some will teach you how to trade this as a book, but not as a book that, let's say, I give you 150 tips, 150 positions, all right, every day, an avalanche of things. Then you have to pick. That's marketing, because somebody will be happy, somebody won't be happy, somebody will make, somebody will lose. That's marketing from the guy. This is a real book. This is the derivative book. With that money that we start from, I will put you position that make money at the end of the period. That's it. And you can see that. You can see that on the results, right? The money you spend and this result. Let me go back. And these are results, put it this way, with witness live. These are real results. This is not the optimization on one that I curve fitting and say, oh, look, these are the results, right? These are the results. It just started, could be just luck. And these are the results after a year of the other one. Now, obviously, we took some loss there, but the important part is this, right? Your exposure, the odds, the Sortino ratio, profit factor, 4.59, right? So the average you've been in a trade, 2.7 days, excluding the wing with the median 1 day, right? So basically, you are outperforming the S&P 500 with the fraction of exposure to the market using leverage. That is the key. But to do that is not a single vertical or a single butterfly or a single calendar. Let me tell you this. You can learn how to free on CBOE, whatever, what a calendar, a butterfly, what the things are, right? But how the things move once you put them on, unless you spend a lot of time doing this, or you do a course that explain to you or show you live, you will not learn, especially looking at things in the past. That's the advantage. That's my offering to you, is that I am prepared to share how I do it. I give you the tools to emulate what I do. If you don't want to do it, to understand what I'm doing. If you don't want to do it, there is an alert, right? I will give you some information, right? But you don't have to be also, if I give an alert and you, let's say, you don't buy the workshop, you can expect that during the alerts, when the market moves, I'll explain exactly the content of the workshop. Because my point to you, I'm a trader, I'm not a, is this: if you want to know all the details, buy the workshop, It's not, so.
Well, that's the questions. Let me just put in the chat the links that you had in the PDF.
So, and that's, trust me, it's a very good deal. It's a very good deal, not because it's money coming to me, because you have 40 between books, spreadsheet and stuff. You can really start from scratch and making a living out of this, right? So that's one. Number two, and it's not compulsory. If you don't want to buy the workshop, you just want to add the alert, or start with the workshop and then get into the alert, or vice versa, free to do that. So this is put it this way, the more intensive one, right? The start with 25K. You can trade with less, and most of the people trade 4 times what they trade for educational purposes only. So it's scalable, right? As far as you keep the ratio the same, right? You can scale it up, scale it down. It just started, and it's already very, very cheap. And a lot of work I put into this, and I don't think that I can go less than $450 per quarter on this one.
And then Rick asked, if you look at the videos and classes, we'll be able to learn why you make a trade at a particular level.
Sure, you will. No, for sure. Well, look, there are 2 parts here. You can analyze the market yourself. I give you the tools to do it yourself. But the first part is understanding the logic, why you put trades. Let's say I designed this course, right? But it's not based on my ideas. This is it's a classic way of trading, right? And I put it together. But is there only one way to do it? My way? That's not my intention. I don't want you copycat what I do, understand what I do. I want you to go through all these tools that I provided to you, all the explanation why I do it. And we start at 9:30 Eastern time with similar trade and achieve, obviously, similar result based on these rules. So that means that is not fixed. You can do it in many ways and shape and form and whatever. But important, you understand the direction and you understand, to put it this way, what are we doing and why we are doing what we are doing, following the fundamentals rules why we're doing this, right? That means not taking direction, because they say, I'm a gambler. I think today the market will go up. You just buy future. Don't need a workshop, buy future. If you really think the market will go up, buy futures, right? You leverage, buy, deep in the money call. Since I'm not calling the market, I don't have secrets here about the market or whatever. There is a method, but you can make more money than me, but maybe me in that day in the alert don't want to take that risk, right? So any individual trader, once they know the rules, can modify the rules according to the time, the capital, and the thing. I just want to be sure that you understand properly the rules and why at a certain point on my trades, I may abandon the trade or stay in the trades. And there is no secret. It's not just I wake up in the morning and say, oh, today I'm not going to trade, all right? Or, I take everybody long. No, it doesn't work like that. So it is important for you to understand this compared to other things that are around is not a tip alone. It's a system based on the rules that you will find out. And if you have time, watch, there is another presentation about the individual free stuff before you buy, right? The free stuff on Iromir's side. Have a look at the method, that we follow. Have a look at the results, and you will notice that those results are in line of what we said. They're not more, they're more or less. Why? Yeah, it could be more. I have a trade today that doesn't trade in this style. It's on an ES. Let me show it to you. It is very risky. I will not recommend it in a workshop. Hold on. And I show it to you right now to see what I'm doing. If I can move my, okay. Can you see this trade?
Yes.
Okay. It's here the simulation because I put it in interactive broker because I put it before market open and I like to trade interactive broker, right? This is a trade on ES. It's a mix of time spread, as you can see, plus there is a future. I sold the future. It's fairly nothing. It requires $33,000 from this morning. I put it on 2 hours before open, right? It's making $3,300, right? With these positions on. Will I have an alert on this? If you are wrong with this, if you put it wrong with this, you'll destroy your P&L, all right? I'm not gonna build an alert just because this looks good, all right? I wanna have something that anybody from any level can start and progress from there, but it's safe, all right? This is safe to me, but would I put it in the hands of somebody that just started a year ago, a trade like this? No, I won't. Because, not because there's nothing that I don't want to share, right? Because I feel responsible. I give you this and you made a mistake, the market goes down. You lose 10 grand on $33,000 on margin here. Then come back to me and say, hey, what I have to do now, what I have to do. If this market goes up, if market goes down, right? By the way, the order, it's already done because as you can see, we are at 62 and there is not much left in the trade, right? So just to explain to you, the trading you can put, as far as you understand what you're doing, the theme is time spread, all right? Being time spread, it will be an advantage for you also to do other kind of trades if you protect your portfolio, if you have, portfolio long or short positions in your, I don't know, in your book. But as I said, I'm not going to show you, I'm very conservative. That performance that you saw there is the minimum performance that I feel like sharing. Put it this way. I'm not sharing the top performer, not because I'm greedy or there is a secret or there's a thing, because I don't think that people buying mentorship for that price with that exposure, with the kind of knowledge could be even higher than mine. But you know, if you don't understand exactly that position that I've been putting for years, will hurt you. Put it this way. And also psychologically, I'm trained. I've been doing this. I don't have a second job. I've been doing this for 35 years. So you know, my reaction to emotions are different.
And Rick asks, can you tell us why you chose that particular ES trade?
No, I cannot tell you now. That's exactly what I said, because you know, it's you see, Rick, you think it's that simple now that in 5 minutes I can tell you why I chose that thing. Um, you know, I expect in the market to move in a certain way. I analyze the volatility. I saw the time of the day. I look at the graph of a similar day in similar situation with the market dive, with volatility at these levels, blah, 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 blah. So it's a long, long process. That was the best candidate. I had another 20 candidates on a software to choose from, right? Why did I select that one? I don't know. I just like it. But it's not why I select that. It's the 10 options that I had working through the system provided to pick. Did I pick the best one? Maybe, maybe not. Maybe there were trades were better. Was I lucky trading this one? Maybe. But you know, the process is that tomorrow morning I'm gonna have another 10 to select. Sometime I'm unlucky, sometime I'm lucky. It's a method, all right? And to be honest with you, sometimes I just select because I'm lazy and I just don't want to read the whole 10. I select the first 3 and I say, oh, let's pick this one because I've been doing this long enough. You know, I'll be totally honest with you.
So Rick asks, if we're following and watching your videos and classes, i.e. the workshop, will we be able to make similar choices?
The alerts or the workshop?
I think the workshop.
The workshop and the alerts, yes, yes. But you had to watch for a while. You had to ask me questions. I always answer questions, you know. Most important, you had to watch those videos I prepare about the Black-Scholes formula, you know, the other stuff, because that is they'll sediment in you, even if you don't know it, right? Put it this way, thinking of a trader is not algebraical, it's matrix. You don't even know what the solution is. You keep trading, you keep reading, you do this for many, many years, and at a certain stage, you know it. You know, it clicks. It's like, you know, I don't think that the good pianist read the, how do you call it, the notes, all right? You visualize the notes. And unfortunately, if you do it a long, long time, you know how it's going to end. Now, would you be able to do that? Maybe, maybe not. Obviously, I'm supported by my tools and my staff, but I've been doing this for 35 years, right? So you ask me a question like, will I be able in a year to do what you did in you learn in 35, making a lot of mistakes, don't take me wrong. I don't know, because I don't know you well enough to know whether you will succeed or not. That's why I decided to do something that give you the best odds, but that is like anything else in life, it's up to you. It's up to you. But let me tell you one thing for sure. If you study all the material I give you, if you really dedicated to this, I think you can make a living out of it. B, you will know more than the people that are not specifically trading this style in any derivative desk in Morgan Stanley, Goldman Sachs, and these guys. That's for sure, right? The form I chosen is not the academic form, because I've been to university, I studied these things. You see no link, right? You study the formula, differential equation, this and that. Then you come out of university. The first time you sit on a desk, you don't know why you spend so much time. People don't talk like that. You know, they do the lot. They don't. I never seen a formula. you know, nobody cares whether you know these formulas or not. So the real world is not made of theoretical stuff. You know, there are people trying to make a living. You need a bit of luck. You have to be street smart, and you have to start thinking. How do I get better at this? You know, especially working inside emotions. You know, what are my? You have to understand your limits. You know, are you fearful? You know, you are a psychopath in terms of, you know, you like to gamble. If you like to gamble, you better don't do this, right? But don't think, if you are an engineer, super smart in mathematics and things like this, probably it's worse. It's worse than a street smart guy, because you think that this can be resolved in a formula because you are smarter than the rest. Well, let me tell you this. The formula, the Black-Scholes formula is wrong. It's wrong. It doesn't solve the equation, first. Second, you don't deal with emotions. Third, Merton made a fund out of this Nobel Prize, lost all the money within 5 years. So, so the guy that, you know, that was the father of the formula. By the way, I will include, I think tomorrow, the original paper from where the formula was derived that give them the Nobel Prize, because I've seen a lot of bullshit around, sorry for the term. And I will give you an explanation, my explanation of the formula itself, mathematically, all right? Without the funny, you know, little cartoons to explain the mathematical simple explanation of the formula, the paper that got them to the Nobel. So the pure, the original, you have to look at this formula, and then from there, I also included in the workshop and the other stuff, a simplified version telling you what it's trying to achieve. But, you know, some people ask me, oh, I want to go deeper. I'll give you the formula. Right? I explain to you the formula, the differential equation. Have a look at the video, you know, study your mathematical book. It's simple. It's not that difficult. Once you follow this, you will get the feeling that actually that formula first was designed for something else. Second, doesn't solve the problem, doesn't help you at all. And a little understanding of the formula, it's probably better not to know anything about the formula. All right. So.
Oh, and Masood asked, are the results including commissions?
Those results that you see, yes. Yes.
And there was another question I saw, but I think it got deleted about, do you discuss the possible trades for Element Shield at the start of the trading day? Is that something?
Yes, I do, but I can
Okay.
discuss in the detail, like the question, you know, if I had to recap, you know, I'm 6 hours ahead of you. I work in the morning as well. So normally I start publishing thing, you know, the theme, whether we put the trade or not, like 1 hour before, you know, but there are some other people that are not in the States that they're already awake. So in the morning, I may share something on Slack and say. But today I say, okay, these are potential trades. These are the trades. I'm telling you a plan of the day, the menu of the day. We're going to put it here, or we need to adjust these trades. We don't need to adjust the trade. Be alerted that probably a trade will come. Sometimes on Friday, I say, well, I don't feel like taking the risk. If there's a longer DT, let's wait for Monday. So you're free to go. Because why is that? Because I think that over the weekend, I will gain, I don't know, $10 to stay in risk. May as well lose $10 or start equal on Monday morning. You know, trading is like this: risk on, risk off. Anytime that I have money at risk, I need to stay alert, you know, give you the alert. But if I take, I don't know, $5,000, this is an example, and my theta is $5, do I really want to risk 5 grand for $5, or maybe I start on Monday, you know, maybe start on Monday. So that's the difference between a real trader, you know, all the formula, all the things. Why do I want to make a position there, you know, if it's not doing anything, right?
Well, we've been going about an hour and a half, so it's probably a good place to wrap it up.
Yeah, wrap it up. Stop me. Just confirming. I believe you started to say that the possible elephant sheet trades for the
Yeah,
day
we just talked
discussed.
about that.
Yeah, okay.
Yeah.
what, not at 9:30. They're discussed a little bit early, because at 9:30, if you put the order at opening, you already have the order there.
Right. And there's the links one more time if anybody needs them. All right. Well, quite the marathon.
Well, thank you very
So,
much. Sorry for, it's just the question took me out.
yeah,
of the-
lots of questions is always good. So
Yeah.
thank you so much. Appreciate all that you've done in the last year, and all the customers I've talked to have been very, very happy with your performance and education. So thank you for sharing all your vast years of experience. I really appreciate it.
No, thank you guys, and for the patient, and I hope we will be partner in this thing, because it's a team. At the end of the day, it's a team.
Right. All right, everyone. Thanks again,
Thank
and we'll
you.
see you next time.
Thank you. Bye.